Hey, it's Soleil, and this is episode 73 of the Orange Pill Investor. I kind of went all in on some of the other strategies that I get flack from. Uh, they say selling covered calls is picking up pennies in front of a steamroller, or stuff like that. Oh, you're cutting yourself off from unlimited upside, stuff like that. So I basically said, buy and hold investing sucks, index fund passive investing sucks. I forgot to mention that real estate sucks, dividends suck. All of that stuff is pales in comparison, as far as I can tell. And let's get into it. So why does it suck? I mean, if S&P 500 gets what, like 7% a year, maybe on average. Real estate probably goes up that much on average. Dividends, I haven't looked at the numbers, but a buddy of mine loves dividends, and we dabbled in it, and I was just kind of like underwhelmed big time. Dividends did not really catch my interest at all. And not only was the dividend return not really, it just didn't ring my bell. But one of the criticisms I've heard of stocks that actually offer a dividend is that they're basically admitting they don't know what better to do with the money. So, like, oh, we don't have anybody that's smart enough or creative enough to come up with an idea how to make our product better, or how to just improve the company and give the shareholders a better return. So they're like, we have two options. We can just buy, take that money and buy shares with it, which would pump up the stock price, or they can just, throw their hands up and be like, I don't know, well, let's give a dividend. So to me, offering a dividend is basically just giving up hope. You're just giving up on growth. You're admitting defeat, really. You're just surrendering. So not only am I not impressed with the money on dividends, but it's just, to me, it's a defeatist attitude from the company themselves. Real estate, tons of headaches. I mean, unless you're just renting to somebody who just never gives a peep and, moves out and cleans the place, keeps up with, helps you keep up with the maintenance or whatever. But I saw a post from somebody on X that, him and his friends had just sold off all of their investment properties and they bought Bitcoin with it. And now they can just sit there and let it grow. And there's no calls from tenants. There's no maintenance to deal with. There's no taxes. There's all of these headaches. They were just able to just live stress-free finally. And they had just been buying property after property, pay off one property, invest in another property, you get another property and another. and something like Bitcoin is just a nearly maintenance-free asset. You have to deal with some security issues with your, cold storage or whatnot, and usher in a little bit of a sense of self-responsibility to custody it yourself. But those headaches are far and away less than real estate. And somebody could come in and change the zoning laws in your area, and they could just screw with the price of your real estate. And so anyway, a lot of these vehicles are just unimpressive to me completely. So why do I say that selling covered calls is better? And the reason is because I'm getting, like, my base case is 52% return a year. If I sell a covered call, let's just do Mara. I've been selling this for quite a while. Even if the price on Mara stays 20 for the rest of this year, it does not budge one iota up or down. I can sell a covered call I mean, just above at the money for 21 and get that's over 5% for the week. 5% a week for 52 weeks, 5 times 50, okay, 250%. It's disgusting. And so, I mean, I normally target at least 1%, but 1% of 20 bucks. If you spent 20 grand, 2 grand to buy 100 shares of Mara, 2100 actually. So, and you're like, okay, I'm not going to be greedy about this. I'll sell a covered call and try to get 1%. You could sell this 25 strike Mara, collect 1% premium. The buyer on the other end of this trade is going to pay you 22 cents. Actually, probably, yeah, that's the ask price even. So they're going to pay you 22 cents times 100 is 20 bucks. And then the only people say, oh, you're surrendering unlimited upside. If this goes to 25 from 21, that's $4. 10% of 20 would be $2. So 20%. These people are telling me that making 20% call away, if the price did go to 50 or 30 or whatever, anything over 25, they're saying that getting 20% return in a week, plus the 1% that I got for the guy buying it from me, that's picking up pennies. If this happened to you every week, if you sold a covered call and the price went up to your strike, and you made 20% on call away value and 1% on the a premium on the covered call, that it's not realistic, but let's just say that could possibly happen. So if you made 21% times 52 weeks, 1,000%, that's stupid. The amount of upside is limited, yes, so that criticism is valid. But be honest, how often are these geniuses that are criticizing picking up pennies in front of a steamroller, how often are these geniuses picking stocks that immediately go to the moon? More than 20% in a week. And the other thing that I do is I don't hold covered calls over earnings. A lot of times those gap ups will be, of course, it could be some kind of good news or whatever. A lot of times companies will report earnings and then the market will freak out and be like, oh, they exceeded, and then, we'll pump the price. So you don't have, it's not just like, okay, it's limited all the time. You can decide when, where, and how you want to limit. So 4 earnings calls a year. So 4 days out of the year, I'm not collecting theta, which theta on this call would be 9 cents. So basically every day you're collecting 9 cents, or times 100 is $9 if you sell this covered call. But the other thing you can do is, if you want to be long a portion of this stock, you can be long. Just buy 110 shares. Now your 100 shares is limited upside to 25, but 10 shares is unlimited. If you're so worried about frickin' unlimited upside, then add some shares in and get unlimited upside. Hell, not even that. Not even that. Let's be a little bit greedier with it, and let's go 10% call away value to $23. They're going to pay you 50 bucks, right? You can take the 50 bucks, rounding up from 49, and you can buy 2 shares of Mara. You didn't even have to add any of your own money. So person A buys 100 shares of Mara. That's all you got. You got 100 shares of Mara. Price goes up, the price of your account goes up. The price goes down, the value of your account goes down. However, person B, me, buys 100 shares of Mara, pays the 2,100, sells a covered call for 23, and then I buy 2 more shares. I didn't put any extra money into the trade than they did. But now I have 102 shares and they still have 100. And then if the price goes down to 20 next week, I sell another one and I buy another share or two, and then, again and again and again. Now, the other guy wins if the price shoots up over 23. Now, person A looks smart and I look dumb, but that's totally fine. I would rather bank 1%, 2%, 3%, 4%, 5% a week and get guaranteed returns. Technically there's no guaranteed returns, but that's in a sense that's kind of not true, because as soon as you sell this covered call, they put that money in your account. It's spendable. That becomes part of your buying power. Just I don't know if people are understanding what I'm saying when I say that, because if worst case scenario, you buy a stock and it gets, over the next year, it just drops. Like $100 stock, it drops $1 a week, and then the next year your account value is 50% of what it was. That's a buy and hold person. Now me, if I buy 100 shares of $100 stock and it loses $1 every week, I still sold a covered call for, let's just say I got 1% and bought another share. So after 52 weeks, I have 152 shares. Now my stock has dropped down to $50 a share, same as person A. Their stock has dropped down to $50 a share. But they paid 100 times 100 shares, so $10,000. I paid $10,000. However, I added 52 shares to my 150, to my 100. I have 152 shares now. I didn't put any extra money in. Now, what happens when the price goes back up to 100? If your assumptions were good and it was a long-term investment and you didn't panic sell the bottom or whatever, and then the price goes back up to 100 at some point. Okay? The other guy bought and held and just sat and just gritted his teeth through the whole damn thing, rode it all the way down to 50, and then he pats himself on the back and rides it all the way back up to 100. Now what does he do? Breathe a sigh of relief and sell and break even, and like, oh, I'm glad I get to get out of this trade now and just break even and then go invest in something else that shits the bed as soon as he buys it? Or do you want to be in the situation where now it goes back to 100 and you have 152 shares? So your account's not worth 10,000 anymore. It's worth 15,000 plus whatever premium you got paid the whole time. If you got 1% a week, 1% of $10,000 is $100. $100 a week for 50 weeks. It's another $5,000. So you could end up with a $20,000 account without putting any more money into it, whereas this other guy just watched it ride all the way down to $50 a share, all the way back up to 100. A year later, he's breaking even. But the potential selling covered calls is you can have more shares and you can have collected the premium. Now, that's a best case scenario. I'm not sure. It's not financial advice, and I'm definitely not promising people that you will double your money every year. But what I'm saying is, when you sell a covered call, that return is guaranteed. It's put into your account. If you sell a covered call at 21, you got paid $100. That's a 5% return. And there's nothing that can change that. Now, the price of Mara can drop to $10 and the total account value will drop in half, but you still got paid $100. You invested $2,000, got paid $100, and that buying power is in your account. So, yeah, even if Mara drops to 10 and your 2,000 drops to 1,000, you actually have 1,100 because you got this $100 here in cash. So I don't know if my, it's not disgust, but my scorn for a lot of the critics of selling covered calls is coming out in my voice, but I just think it's hilarious. The two main arguments that I hear are you're giving up unlimited upside and you're picking up, which is basically when they say you're picking up pennies in front of steamrollers. People like to, somebody said it once, it was a clever as shit thing to say, but it doesn't hold water as far as I can tell. I mean, feel free if you're out there and you're like, oh, my strategy gets me more than 50 to 100% a year regularly. I would love to hear about that strategy in the comments. Now, something like, I don't know, day trading, momentum traders, trend following, stuff like that, maybe that works. Maybe you develop some trading algorithm and it just prints you money. Okay, cool. I would love to take a look at it. But the TradFi stuff, the buy and hold and the dividend crowd and the real estate crowd, this stuff doesn't compute to me. And sometimes I see posts like, oh, got 7% on my blah 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 for the year, and I'm like, what? What are we talking about here? Why is that noteworthy? That's like a really good week. I mean, this is expensive as crap. But MicroStrategy is trading for $1,500. You can get it's disgusting. You can get 4 days to expiration. Is next week a holiday? Anyway, 10% of 1,500 would be 150. So this is 2/3 of 10%. So what, 6-7%? You can get 6-7% at the money. Now there's no way in hell I would make this trade because I've actually been kind of getting wrecked in MicroStrategy. And when I say getting wrecked, I don't mean like losing money. I just mean I haven't been gaining as much money as I could have because I was selecting strikes that were too low. And the price of MicroStrategy was just blowing past my strike. So picking up pennies in front of steamrollers was kind of true in this case over the last couple of weeks. MicroStrategy went absolutely frickin' bonkers. But if you get 7%, let's just do 6%. Let's start the calculator again. Actually, it's not a lot. Actually, it's not that hard. So 6% times 50 weeks is 300%. That's not pennies in front of a steamroller. That's sick. But let's say we did want to protect ourselves from like a 20% move. So $300. If MicroStrategy gaps up to 1,800 again, how much can we get at 1,800? $30. So 1% would be 15. So that's 2%. You can get 2%. You can get 100% return for the year selling covered calls with a 20% callaway value. Not everybody can afford MicroStrategy, but it's just an illustration because right now MicroStrategy is on a tear. So this is like, I mean, stuff like this can happen. But even HUT is like dirt cheap. These are two opposite ends of the spectrum. And HUT's like $9. Selling an at the money covered call for this week. I mean, you can see that I have 1.9.5. This is my 5K account. I'm doing a challenge. But you can get 60 cents at the $9 strike. 6 times 9 is 54. So you can get 6% at the money with like even a little tiny bit of callaway value there. That's not even the worst trade that you could make. Now this is after hours, so the price could have been dinking around here. This might not be completely accurate. I think I got like 50 cents up here. That's probably pretty close. I got like 50 cents or something, 50 cents at the 9.5 strike. That leaves 70 cents call away value on a $9 stock, 7 times 9 is 63. So it's like 7% call away value and 45, 5 times, yeah, and 5% premium. 5% premium, 7% call away. These numbers are crazy. Now, every stock's not like this. I mean, like an Apple premium is probably trash. So Apple costs 170, but even if I was dead set on Apple, I would still do this. I mean, 1% of this would be $1.70. So I mean, you would, yes, yeah, that's why I don't trade Apple. You'd have to sell basically an at the money call just to get 1%. So what, half of 1% would be maybe 80 cents, 90 cents, like half a percent with 1% call away value. I mean, but if somebody held a gun to my head and said you got to trade Apple, I would still do this. And then, I'd be shit out of luck when Apple gaps up 10, 20%. But I would still maybe just go up here and just get something. Or hell, just do what I was saying before. Sell a covered call, have 101 shares. Now I'm long 1 share. I got the guaranteed 1%, tiny little bit of call away. But I mean, but even actually, you can just go out farther. So I usually do sell the weeklies, but you can go out to 45, 50 days of expiration. And you could go up to, what, call away value of, let's see, 10% would be another 17, put you at 190. You could get 10% call away value over the next 40 days. And then what you would do is, at 45 days, the theta actually really starts to accelerate. Theta is just how much money you're going to make every day on this call, selling this covered call. It's how much value is decaying out of the account per day. So for this one, it's 4.04, which is basically 4 cents a day. So over the next 2 to 3 weeks, you sold it for $1, and then you're going to try to buy it back for 50 cents in 2 or 3 weeks. If Apple's trading sideways. If Apple trades up to 190, okay, you probably have to hold on to it for 40 days, then you sell it for 190. You made 10% in a couple of weeks, 5 weeks, 6 weeks. You made 10% in 6 weeks, which 6 times 9 is 54. So you can do that 9 times a year. So if you made 10% 9 times a year, that's still plus the 1% that you made. Well, 1% you'd have to go to the 185 strike, but plus a couple of percents here and there. It's just, to me, this is a no-brainer. To me, it makes less sense on something like an Apple, but these Bitcoin mining stocks, the premium is just sick. And Tesla is kind of disappointing me lately. Tesla is like, kind of use it as my trading pair against Bitcoin stocks. I want to have something that's at least somewhat not correlated to Bitcoin. And I'm a big believer in Tesla. And so it's kind of like my number 2 trade. Actually, a very similar price to Apple. That's weird. But you can get a little bit more call away value. So you could get 1% at 175. That's about almost 2% call away value. So a little bit better than Apple. But in a scenario like this, I would probably be more greedy with the call away value. I would probably go all the way up here to the 180 in case Tesla gaps up 5-10%. I want to catch most of that, and then just take this little bit of premium on the side. So I still trade Tesla, but it used to be much better premium. So kind of bumming me out. But anyway, I think that's enough of me ranting about it. So And actually maybe I'll say this. I think people are afraid of options, but it's not hard. It's so the people what gives options a bad rap is, let's just do Mara. So people go here, they're like, oh, I got approved for options. Oh, okay. I want unlimited upside. I'm gonna buy this. I'm gonna go up here and I'm gonna buy this $25 call here. It's only gonna cost me $20. And then if the price goes up to 26, I'll make $100 and I'll turn 20 into 100. That's what they do. But calls that you buy almost always become worthless. They almost always expire out of the money, and the seller gets all the money, and the buyer loses all the money. So that's why I'm a seller. I stay on the side of the trade that wins most of the time. Occasionally it will lose, but when you own the shares, the covered call, the selling the call doesn't hurt you. Because if I own the shares and the price of Mara goes to 100, I just give up my shares. And the other guy, okay, he won the lottery. He scratched a lottery ticket and he won, and it was technically at my expense or whatever. But if I bought for 20 and I sold for 25, I still made $500 on a $2,000 investment. Am I supposed to be jealous that this guy won the lottery and he made what, $7,500 on a $20 lottery scratcher? It doesn't bother me in the least. I'm happy with other people's success, and that's the other thing. Selling covered calls is the most ethical trade in the stock market, because if the price does gap up, both parties win. You win from 20 to 25 if that's your strike, and if it goes to 30, the other guy wins from 25 to 30. So you made $500, they made $500, and actually you got paid 20. So you made $520, he made 480 because he paid 20. So he makes 500 minus the 20. You make 500 plus the 20 that he paid you. So everybody's happy. If the price goes to 50 and he makes $5,000 or whatever, 2,500. He makes 2,500. So maybe it is $5,000. Yeah, because he gets 100 shares. Oh, but he still has to pay for them. So he still has to pay 2,500. The price goes to 50. Yeah. So he's got $5,000 stock, but he paid 2,500. So it's still win-win. I'm not going to be mad that I made 500 and he made 2,500. Every winning trade is a good trade. Pat yourself on the back. If there's something you needed to learn from it, learn from it. Adjust your strikes next time. If you got a volatile stock, like, if Bitcoin gaps up to 75, these mining stocks are all going to pump. So maybe you don't want to be so greedy with the premium. Same for Tesla. There's not a lot of premium to be had, so I'm not going to focus on the premium. Well, actually, so with these Bitcoin mining stocks, you can go in either direction you want. You can be extremely greedy because the premium is so nice, or you can be not greedy with the premium and allow for a bunch of call-away value to account for that. It's just completely customizable. You can buy 150 shares and be 100% long in the 50. You can buy whatever the heck you want to do. All right. I think I made my case. If I didn't, there's probably nothing I can think of to convince you. But it's not hard. You buy 100 shares, you click sell call, and then you click continue, review, and you submit. Well, I don't have enough buying power on this. Oh, no, I don't have enough shares. I'd have to buy 100 shares first. So it's like 4 clicks. As long as you sell a strike above your cost basis, whatever you paid for it, you kind of can't lose money on the trade. The price on your stock goes down, of course you can lose that money, but that's the risk that you take anytime you buy stock. If you don't want to lose money on stock, don't buy stock. Go do something else. All right, I really do got to end it before I start running off the mouth anymore. All right, be good, John.